you're watching Ask Udayan, the show where we answer your questions on stocks. Let's go across to our global business editor, Udayan Mukharjee, and get started on some of those queries today. And remember, if you want to send in your query, the number will show up on your screen. Simply send in your request and we'll try and take a select few every week. Our first question for Udayan today is from A. Kumar in Bengaluru on none other than LIC.
Sir, what is your advice on holding LIC shares? I bought it during the recent IPO.
I know it's not been a great experience post-listing, and I cannot promise that the stock will bounce back immediately and you'll make lots of money as you go forward. I mean, if you're a long-term investor and you like the LIC story and its dominance, it's probably okay to still own it, but I don't think you will make better than market returns from that name. I mean, if you just look beyond the LIC hype of the size and the reach, etc., there is no getting away from the fact that this is a company which is steadily losing market share. It is not growing at the pace at which the insurance market is growing. Also, the kind of profile of products it has, which is basically mostly par products and not so much savings or protection oriented, where insurance companies actually make higher margins and most of the profits. LIC is not a dominant player in those kind of products at all. So if you look at the fact that this is an incumbent which is steadily seeing market erosion, and its product profile is not the highest profitable kind of a profile that you can have, and you add to that the fact that a very large part of its value or valuation, which is the embedded value, is derived from mark-to-market premiums on stock market holdings. The fact if the market goes down, LIC goes down with it is absolutely indisputable. Basically, it's a proxy for the stock market in a sense from a valuation point of view. And you put all this together and you're owning a stock which doesn't have a great growth case going for it and probably has a lot of market attached volatility along with it. So I think this will remain a fairly volatile company stock, and I doubt whether it will outperform the market or even other insurance stocks in any meaningful way. So it's a disappointing listing, and I suspect that it will continue to test investor patience in the months and years to come.
All right, Preeti from Bengaluru has a question on another fairly recent listing. That's Paytm. Let's listen in.
Hi Udayan, this is Preeti here. I am calling from Bangalore. So I just had a small query regarding the Paytm shares. So I had taken a few of these shares from their IPO, and as you can see that the prices of these shares have been constantly going down ever since, and I just wanted to know if it will be a wise decision to sell it at this price, or is there any possibility that these prices of the Paytm shares will go up in the near future? Kindly advise. Thank you.
Well, it's very difficult to dispense with trading advice on a volatile name like Paytm. I mean, you could get a bounce back. I mean, the stock did go down all the way to 500 rupees and has worked its way back to about 600. I mean, that itself is a 20% plus rally in just a matter of a few weeks. So rallies can happen in a stock which has collapsed from 2000 to 500, which has lost 75% of its value post-listing. So you could get pullback rallies. But the case for Paytm is still very wobbly. The biggest problem, of course, is valuations. You don't know how to value a stock which will probably not make any kind of profits, even at the EBITDA level, till FY26. So the whole profit picture on which stocks should be valued is so far out in the future that it's very difficult to make a clear or decisive valuation assessment on that name. While its payments business continues to be fairly strong, even the recent quarterly numbers were not bad on that front, I think they're making very slow progress on the lending front or the financial services front, which is what might determine how Paytm's stock future actually pans out. So keeping all this in mind and the fact that there is such a lot of bad taste in the mouth with that stock, given how poorly it is done post-listing, I mean, I wouldn't want to give you a recommendation on how to act, but I would say, you know, this is a stock where probably if you get smart rallies, it might be not a bad idea to switch to something which is far more stable, has profits in this kind of current market volatility. Paytm is not the kind of stock which does well in the scenario that we are in right now. Intense global volatility, global market corrections in technology sector, reassessment of valuations in the light of rising interest rates, this is not the kind of domain in which Paytm will do well. So if you're lucky to get these rallies, maybe you need to switch to more stable sectors.
Okay, Ashish Gandhi from Chennai has a query on a far more consistent performer. Let's listen in to what he wants to do with DMart.
Hello sir, this is Ashish Gandhi from Chennai. Just want to know that I have purchased 70 shares of DMart at 2,222 rupees. Should I hold it or should I sell it? Please advise.
Well, you've gotten at a very good price point, so there is no problem with that. You're sitting on handsome profits. And as you just heard, Avenue Supermarts is a very, very consistent performer over the years. And its FMCG business continues to do well. Their new store addition is very aggressive. Same store sales growth is also not too bad. Of course, there are headwinds now because of, inflation, disposable spending from consumer households. I mean, these are all challenges that Avenue Supermart will continue to face over the next few quarters, and there's just no getting away from it. But the structural story of a company which executes well, and the fact that there is a continuous shift, secular shift from unorganized to organized retail buying, I mean, these are very, very strong tailwinds for a proven company like Avenue Supermarts. The problem is and has always been valuations. It's a company which, while it continues to grow at 25% plus, it's trading at 70 plus PE multiple, which is always a challenge in this kind of a market scenario where rates are rising and valuations are compressing. So stocks like Avenue Supermart could easily shed some notches in their PE multiple, which might restrict stock price performance going forward. But if you're the long-term investor kind, then I think you should not panic. You might see some valuation compression, but as long as you don't see a complete fall off in the growth metrics, you probably are better off keeping on owning consistent compounders like Avenue Supermarts.
Kalpesh Patel from Mumbai has a question on Polycab. Let's listen in.
Hi sir, I am Kalpesh Patel from Mumbai. I am your follower last 20 years. My question is upon Polycab. I have 100 share at the rate price of 2750. What should I do? Should I hold, or exit, or buy more?
Well, there's no reason for you to panic because, Polycab is one of the shares which has actually held up very well through this correction, I would say. It's not collapsed at all with the rest of the mid-cap and small-cap pack. In fact, if anything, in the last 6 months, it's been consolidating very nicely in a price band. Even if you look at the price from the peak, it's not fallen a lot at all. I think it would have outperformed most mid-caps, and that is a testimony of the kind of stability of that business. I mean, as you know, since you're an investor, that it is a leader in the wires and cable segment, and if you looked at this quarter's earnings as well, year on year the wires and cable segment grew at 40%. So they're constantly adding market share to their bread and butter business. On the what they like to call FMEG business, their fast moving electrical goods business, that is seeing some kind of demand compression because of inflation and consumer discretionary income getting squeezed, and this is a headwind which Polycab will have to deal with. There's no getting away from it in the next few quarters. But it's still a company which is exhibiting very robust growth, 20% kind of growth consistently over the quarters, sometimes more. A steady 17, 18, 19% kind of ROE or ROCE return profile, which is very commendable. Sure, it's not a cheap stock, but I think given its strengths in the core wires and cables and the higher margin electrical business, I see no reason for you to panic with this one. This probably belongs in a high quality portfolio, a long-term portfolio, so you probably own a good stock and there is no reason to get worried about it.
All right, on that note, that's all we could fit into the session today. Udayan, thanks so much for taking all those queries. We had a couple of underperformers and very cautious investors worried about their investments in the likes of Paytm, LIC, and on the other hand, we also had some very consistent performers and possibly better to hold on to some of those quality stocks.